OCI. This is called reclassification adjustments. This will happen in any company. Many people ask me, our company is not interested in revaluing assets. So why do we need to learn OCI? OCI you cannot avoid for two things. First thing is any company will have some sort of investment. Maybe equity, maybe debt. And second thing, you cannot ignore your gratuity and pension or leave encashment, employee benefits. There you will have to think OCI. Because you provide something here, claim will come up after 20 years, might be 30 years. You need to make a provision. Adjustments will all go through OCI only. So that is called vertical consistency. Second, yes please.
OCI means?
Other comprehensive income.
This will be covered in the accounting standard of revenue. OCI?
It will be covered in Index 1, presentation of financial statements. First thing I tell you that everybody has to go through the standard. This is the must. You think of any lawyer or any lawyer or any company law expert, any top person in a big boss, he gets stuck. First he goes through the bare acts, what is there. One thing I have seen, I can just forget that situation. Some people from customs, they came to that shop there, Book Corporation, you know, it is in in Dalhousie Square. बोले किताब दो बोले कौन सा किताब बोले कस्टम एक्सरसाइज जो है सब दे दो बोले क्या हुआ है from Bangladesh 4 lakh or 10 lakh I don't remember birds came chicken okay they are not very sure it is allowed or not. If it is not allowed, if they return, they will die in the journey. Okay? Imagine the situation. Jitna sara kitab hai, uda ke leke chala gaya. I'm good. Here actually what happens, these are all very articulated. If I tell you what is OCI, I need to take an example of property, plant and equipment. What is said? Revaluation surplus. Then I am to take each and every transaction, there has to be income tax effect that I will have to show. So minimum these three standards I need to together, keeping in mind conceptual framework for financial reporting. Second is horizontal consistency. Now, you issue something for 75 rupees today, deep discount bond, and you will be redeeming after 3 years 100 rupees. Okay. Your effective cost is 10%. So every year what you have to do is have to charge. Anybody having the calculator with you? Any of you? That means this mobile, huh? 75 into 1.1, how much? 82.5. So the value of the bond is 82.5 at the year end, first year end. What is the entry? Interest debit to bond. Okay? Second year into 1.1. So that amount of interest second you debit and last year into 1.1 should be 100. Yes. So 3 years interest you have to show. So that becomes your horizontal consistency. But many companies have done this. And one company lost about 300 rupees on their stock in particular one day for making this mistake. Third thing is third dimensional consistency. You have to accept the rule of the trade. If you start a bookshop in college, you have to accept that you have to give 10% discount to all. If you deal in sugar, you must know that you have to pay cash only. If you do it other business, you have to accept everything. Effective interest rate. What is the effective interest rate? We talk about my liability going up, going down. Why? My credit worthiness going up, it is going down. Why? Because the market rate is different from mine. I have issued bond, say for 9 rupees, 9%. Today nobody is interested to lend me money below 12%. So there is a change in the carrying amount of my liability. There is a change in my credit worthiness. That is called third dimensional consistency. Variability. Direct, indirect. You make your physical stock, you make a direct verification. What is indirect verification of your stock? Anybody? Huh?
We do the physical verification.
Yes, one by one, please. I can hear you. You make your physical stock direct verification. What is the indirect verification of your stock?
Opening plus purchase minus sale.
Opening plus?
Purchase minus sale and loss. The closing balance should match the.
What method you follow? FIFO or weighted average? That is indirect verification. What method you follow? That is your indirect verification. Because inventory, you see, they are all fungible assets. They lose identity when they get mixed up. They all look alike, but they acquired at different rates. So directly I say it is 100 units first class, no problem. Now what method I follow? It is FIFO, it is weighted average. That is my indirect verification. Now I talk about carbon credit. That is called, in UK I have seen it is called green electricity. I have certain certificate. This I can sell at fair value. Because I have earned this, maintain the environment. That is my government credit. It has no value. So there can be only one. There can be no indirect verification. Timeliness. What is that?
But carbon credit, we are not valuing it.
Pardon?
Carbon credit, we are not valuing it at the time of balance sheet. We just, whenever it is sold, we just account for it.
I told you without the value it added with the inventory. Without the value added with it, treated as government grant. Treatment is same as government. It is not that I have to get money from the government. Government asked me that you take money from others. I am talking the theoretical concept of this. Is it okay? Timeliness. You are showing me one document. This land I purchased for 5,000 rupees in 1955. Yes. Reliable. Relevance? Zero. Relevance? Zero. No relevance. Even 10 years before, per day 100 point increase in stock market was topic for discussion. Today, nothing. Actually, timeliness balances the merits of timely reporting and the provision of reliable disclosures. I told you earlier, Arey bhai, there is some contingent liability, case is pending in a court of law. There is quite possible you might lose. But हम तो last year कर गया, देखो ना contingent liability. Last year तो किया था 1 लाख रुपया, आज का value क्या है? Change it. Contingent liability is the same. Now you see that contingent liability is still contingent liability, or it has already become a provision. Something was possible. Is it not that it has become probable? 18 runs to win, 3 balls remaining. Okay, it is possible for the batsman to score 18 runs. But is it probable? No. So you have said it is contingent liability. Are you sure it is still contingent liability? It has already become a provision. That is the timely presentation of those. Anything is not timely, doesn't make any sense. Understandability. This is very, very important. It is taken for granted that the reader having reasonable knowledge of business. For you, simple thing, it's very hard things I'm telling you. You are all in accounting profession. Without the knowledge of Ind AS, you are simply out of accounting fraternity. Because things are all very, very new things. They have done many research on this. They come out after a long discussion for so many years, so many people are getting involved in this. So again I am telling you, you will have to go through the standards first. Now, first carve out what I have said, that in Ind AS there is no conceptual framework for financial reporting. One biggest, three other carve outs are there that I personally feel. First thing is, you go through one paragraph suppose, okay? You don't understand. What is your resource? You think a while, but still cannot get the answer. So what do? You try to find out some other sources? Yes or no?
Yes.
Huh? You talk to other people? They have one thing called application guidance and one thing called implementation guidance. What this is for? That thing is not there. And most important, above all, each and every standard having some examples given. That is not there in Ind AS. I do not know why. Somebody talking about this revenue standard 115. Hardly 1 year left. That is the biggest standard having more than 100 examples. When I saw that for the first time, I was really at my wit's end. So I decided 3 months I will see. I'll go through only this standard only. I'll not study any other standard. No lectures, nothing. Sitting at home, I'm studying all this. There they have 100 examples. Now, can I expect you that you understand, you see Ind AS 115 without those examples? Now, suppose you sell 100 units, okay? Huh? And you estimate 5 units will be returned. I don't talk about bad debts. What do you do? No entry nowadays? When it is returned, you pass the entry? Is it a correct procedure? You have sold 100 units and you yourself not expecting to get revenue from 100 units. You take it for granted that around 5 units will be returned. So revenue should be taken for 95 only. If you have received money, that is your contract liability. You cannot take revenue for 100 units. So it's a huge, huge thing. Next.
So one thing, how many users can understand this IFRS statements without having any idea about IFRS?
Impossible.
It's for so many
Impossible.
different stakeholders.
Impossible.
So then what's the point of making it in IFRS when the users start understanding?
That the lawmakers you ask. If I teach in a college, I cannot change the syllabus. Can I? Then I'm not the vice chancellor. I'm a very small part of accounting standard board. Very small part regarding the study committee and all these things. Okay, I asked this question, I can get the answer. Ultimate organized responsible is NCA. Now they have deferred for so many years. Just imagine. Even today I see that boys are studying so hard on the top floor, preparing for CA exam. They're studying so hard. What they learn will not make any sense in their life. Amalgamation, absorption, reconstruction, capital reduction, imagine, sale balancing ledger, books and records destroyed by fire. Imagine. Even a small shop on the pavement, he maintains accounts. Even a beggar talks of WhatsApp. Can you imagine? Huh? Person selling value in the market, but like you all are implementing assistance, what? Mobile. Purpose, we are not the lawmakers, we have to abide by what they do. काफी बेट का सवाल है क्या? अच्छा, these are the things I told you. Anything relevant, anything reliable may not be relevant. I have the document. There are many cross-cutting issues. And in accountancy, I tell you, there is no specific theory. One theory is very good for a particular situation. Say for example, deferred tax liability, it's a prudence concept. Anticipate no profit, provide for losses. So if you are supposed to pay, as per your calculation, 3 rupees income tax, if you have paid 2 rupees, 1 rupee is your liability. You set aside some profit and keep it there. That is what? Prudence. Deferred tax asset is what? Anti-prudence. One more thing. Value, simple thing. Cost and market price, whichever is lower, stock. So I lower down my stock, I reduce my profit. So if I reduce my profit by 10 rupees, next year my profit will be automatically increased by 10 rupees because this year's closing will become opening stock for the next year. That's why this is called conceptual framework. These are all developed from accounting practices. There was sales tax, then there was service tax, then there was VAT, now there is hue and cry on VAT, GST. After what? And within, I tell you, it is 2000. By 2020, there will be IFRS only. There will be no Ind AS. There is hardly 1 to carve outs. That will not be there. But one advantage I tell you that if you learn this IFRS, if you are good at Kolkata, good anywhere in the world. If you bad here, bad anywhere in the world. So for you, for the young, I tell you, you are fit anywhere in the world. And you don't need to go, even sitting at home, you can do a lot of things. You can teach US students, they pay in dollars, you can write articles, you can explain, you can develop your own case studies. But staff, you have to know, and for that you need to go to the standards. Next.
Can you please explain the second one?
Pardon?
Prudence and materiality, conflict between prudence and
Comparability.
materiality. No, the second
There may be a conflict between prudence and materiality. Yes.
Prudence and materiality. I need to be very prudent. But the amount may be too small to be of any consequence. So I ignore this. I simply ignore this. Amount is too small to be of any consequence. Material depend on the degree and the value of your company. For a small company, even 1,000 rupees is a substantial amount. For big companies, it is nothing. Next. This is real, R-E-A-L. R stands for revenue. E is expenses. A is asset, L is liability. Can there be any revenue without expenses? Just visualize real, R-E-A-L. Can there be any revenue without expenses?
Carbon credit.
Yes, brilliant, I'm impressed. Government grant. What is that?
It's say you have incurred expenses for non-polluting the atmosphere, so that's the cost. The expenses you have incurred for in order to earn.
If you don't do that, you have to buy from others.
But
If you don't do that, you have to buy from others. What is that? Then?
for carbon credit, huge expenses has to be incurred.
Huh?
For earning carbon credit,
Ah.
for evaluating the carbon credit, huge expenses has to be incurred.
That is taken as part of the cost of production.
Indirect expense.
There is a thing that you should do. It is taken as extra income. Yes. Second thing is coming. Can there be any expense without an asset? Do I need asset to recognize expenses in the PL?
There can be loss also.
Huh?
There can be loss also.
Expense loss is the same thing. I don't get benefit, I get benefit.
And advertisement expense
Without,
advertisement expense is
don't pay money.
no, there is no asset involved. Advertisement
Later,
expense.
There are expenses recorded, expenses that is estimated. Provision is an expense. And lastly, assets and liabilities. The first thing we are taught what? Assets is equal to liabilities. Why? Because accounting is always done from the point of view of an artificial person. And one artificial person having no capacity to own any asset nor incur any expenses, meet any liabilities. So assets is equal to liabilities. The most thing that you'll have to see here you will find many peculiar journal entries. Profit and loss account debit to asset. Profit and loss account debit to inventory. Many things you will get. One asset will not affect my PL. One particular thing, one transaction will affect directly my balance sheet. Now, there will be many complex transactions. Say for one PPE, property, suppose one plant, revalued. How many adjustments could be there? One plant, 10 rupees, revalued at the end of the year at 12 rupees. How many adjustments will be there?
comprehensive income and
First entry is what? Asset account debit to revaluation surplus. Say 100 rupees is the asset, revalued for 110. Okay? So asset account debit revaluation surplus how much? 10. That revaluation surplus has to be net of tax. Revaluation surplus debit to deferred tax liability 3 rupees, say income tax 30%. Already 3 adjustments. Next,
And what about
when you,
depreciation?
yes please,
What about depreciation on increase?
coming. Next, there will be some extra depreciation. Yes or no? Provided the life is the same. For the extra depreciation, what will happen? Your profit will
Increase.
go down. What is the effect on EPS?
Go down.
Go down unnecessarily, just one book entry, no outside connection. Imagine one simple journal entry reducing my profit, my EPS. The most important figure in PL is the EPS. Lastly, I make an adjustment of this deferred tax liability, what I created, originated, now has to be reversed because of this extra depreciation. Last thing, that revaluation reserve will be transferred to my retained earnings. So each and every asset I need to maintain if I revalue asset. What is the revalued amount? What is the cost amount for many years? 5 years, 6 years might be. Because I am charging extra depreciation, my profit is getting less. Same amount has to be transferred from my reverse surplus to my retained earnings. So there are many complex transactions. I'll have to keep in mind that any time I earn 10 rupees, my actual income is 7, provided it is not exempt from tax. I spend 10 rupees, my actual expense is 7 rupees, because 3 rupees tax I will save. Equity is not defined in this. They talk about equity instruments. Simply they said excess of assets over liabilities. They say this is asset, liability, excess of equity. So equity, generally what do you understand? What is my common sense wisdom? We understand preference shares, we understand some equity shares, some reserves and surplus, some retained earnings, that's all. But here they take all these capital adjustments, revaluation surplus, equity portion of convertible bonds. What is coming, there is one separate section you will see that is called statement of changes in equity. They start with share capital, then retained earnings, then everything, fair value gain on equity investments, revaluation surplus, cash flow hedge, then defined benefit obligations. Everything is coming there. Now we take one by one. One standard tell you what non-financial assets. One standard tell you financial, that is the financial instrument. Simple thing, my asset, somebody else's liability. That is financial asset. My asset, somebody else's liability. What is that? Account receivable. My asset, somebody else's equity. Investment in equity instruments. So it can be loan receivable, it can be bond receivable, it can be anything. So plus tell me 4 examples of financial assets. Number 1 is cash. Okay? Account receivable.
How cash will be your liability? My cash.
Yes.
How my cash will be your liability? Will have anybody else's liability?
Whose liability is this? Cash is something that other assets are expressed with that only.
So, what our contention is that what?
Cash is, I told you there is no specific rule. Cash is something other assets are expressed in that monetary unit. So if I have cash, it is my financial asset. If I put the money into the bank, is it not bank's liability? Next, lease receivable, loan receivable, non-financial asset, property, plant, equipment, intangible assets, which has no outside connection. Same thing, liability, bonds payable, loans payable, sundry creditors. Tell me at least 2 non-financial liability. 1 liability having no outside connection.
Reserve surplus equity.
Now, तो सर equity हो गया ना. That's equity. Who are content doesn't find a place in the balance sheet, sir. Deferred tax liability, make it simple. That is complicated. That is the answer is correct, but make it simple. Warranty provisions, deferred revenue. Decommissioning liability. If I make provisions for warranty provisions, nothing to the outside world. Deferred revenue. Okay, next. Just opposite of that. Okay, same thing. Next. Sometimes assets, liabilities, they don't appear, though they are very much there. Financial guarantee contract, parent guaranteeing, no record. Some forward contract, there is no initial recognition. Performance bonds. You are the contractor, I am the contractee. I tell you, you have to complete this work by 31st December. I issue you bonds. If you cannot enter, amount will be forfeited. Next, equity. Regarding equity, we should have some wide knowledge. You see, you have to see what is called statement of changes in equity. My opening balance of equity share, thereafter is there buyback, is there bonus, is there further issue? What is the closing balance? Just to balance sheet, all items, not PL, how they are changing. Opening balance, retained earnings. Closing balance, how much profit transferred there, how much dividend I have paid. Thereafter, other components of equity. That is the most important and new thing for Ind AS. These are mainly all coming from OCI, barring few. One is coming from share-based payment, when your fair value is more and that is not debited in PL. And second thing is for compound financial instruments, they are recorded directly in equity. So equity has a very special meaning and everywhere it is in use. So you must have a thorough understanding of this. Next is income. Realized gain will go to PL, unrealized gain will go to OCI, other comprehensive income. From there it will go to statement of changes in equity. Regarding revenue, there are two things. One is called revenue, one is called gain. Revenue is from my ordinary activities. What I wish I told you that revenue standard, that 115, that is very, very important. Now what we do and what they asked us to do, it's a much better approach. Suppose revenue can be recognized when? It can be recognized, there are two possibilities, at a point in time or over time. Suppose I sell you one car. How much I charge? 100 rupees. 80 rupees for the car and 20 rupees for what? I will provide you for services. So 80 rupees revenue I take it into immediately, revenue at a point in time. And 20 rupees will be what? If I get 100 rupees, 20 will be my deferred revenue. That will be recognized over time. One service I will provide and 5 rupees I will be taking that. Suppose entire IFRS is based on fair value, you know very well. We talk about fair value only. And fair value you see everywhere. Anywhere you go, you see fair value only. The biggest example you see, all cinema halls are converted into mall. That is fair value. Simple thing. वो पोसाता नहीं है 10 रुपये 20 रुपये आज का not आज का जमाना में क्या टिकट का रेट है, not possible. All the old houses demolished, sentiments all gone, big multi-story building because these are fair value. Now, here something is called unwinding of discount. Suppose, very simple example I am taking. You buy one flat for 1 lakh rupees, 1st January. Okay? Delivery after 2 years. At what price you will record your flat when you get delivered 2 years? You are the seller. You have sold one asset for one flat, one under construction, sold for 1 lakh rupees. Okay? Delivered after 2 years. When you will recognize your revenue and at what amount?
At the time of delivery.
Yes, how much? Definitely not now. You have received 1 lakh rupees, that is your liability. It's not your revenue. Cash account debit to liability for future delivery. After 2 years you deliver the thing, what will be the amount you recognize as your revenue?
Interest cost.
Yes. Now the question is, if you provide income, say 2 years interest, say it is 1,10,000 rupees. 10,000 rupees interest to show and you show revenue as how much? 110. Do you get that money? Then how your trial balance will tell you? Any expense we debit in the PL not paid for, it becomes our liability, yes or no? Any expense we pay, we don't pay. If we have debited expense 10 rupees, 8 rupees paid, 2 rupees not paid, it becomes our liability, yes or no? The moment we pay, it does not involve PL, 2 rupees out, cash 2 rupees out. Here if I take interest for 2 years to show the faithful representation that 110 rupees is my, 1,10,000 rupees is my revenue, then it will be what? I not get any, I got only 1 lakh rupees. Then I shall have to show both that this is my revenue income, this is my cost, because I have enjoyed 1 lakh for 2 years. Same thing when I talk about CFO given 5, he will be giving back 5 only. There is no cash transaction. So first you show this is the remuneration cost and this is the benefit given to him. Next.
So this amount we never had with you. You kept spending from this amount no, to construct the house.
Yes, please.
Suppose you sold a flat and you got 100 rupees. So flat will not be made automatically.
I'll be showing interest received 10,000 rupees and interest paid 10,000 both.
So whether that 10,000 will be deducted from the interest paid and it will be shown here paid.
I am to show both. I will balance will not tell you. Because he is not going to pay. He is paying 1 lakh only. But actually I have received how much? 2 years money lying with me only. But
Sir, it is in 2 years. The first year interest will pass and second year.
yes.
What is
First your liability will increase for first year's interest. Yes, expenses. There are, sir, frankly speaking, there are many things in many places. My biggest regret, I tell you, that for the last 11 years I have been studying IFRS only, leaving everything. You see, I wrote many books in my life. So, but the thing is, I'm a loner, very frankly speaking, and thing is, it's a very vast thing, huge thing. Many places I am not very, I'm sure that the standard discipline is wrong, IFRS. But sometimes you cannot say that you are wrong, you see. You should be polite, humble. So I wrote to them, that is one, they have one section, what is that name? IFRAC. ISB is the body that releases all these standards, and IFRAC is the research foundation, they finalize. So I wrote to them, chairman, that these are the places I do not know. I was very humble in writing that I do not know it is maybe it is wrong or misleading, or maybe it is my oblivion. I have not understood. See if you could clarify these queries, because in 2 paragraphs in 2 different standards or to 2 different meanings. One said go this way, and go that way. Anyway, so they said okay, after 4 months get in touch with me. After 4 months I send an email. But you send question one by one. Till today I didn't get any answer. So here I tell you that so many things we are taught. There is one paper in Calcutta University, Delhi University, accounting theory. I must be knowing, those who have passed in last 20 years. That is the most important, the entire conceptual framework. That concept one has to be there. Because everything is based on logic. What is not managerially impossible, we exclude. Anybody doing any business in Kolkata must have one trade license from Kolkata Corporation. Is it possible to have Fuchkawalas will have trade licenses? Is it possible? 1.5 lakh Fuchkawala hai, sir. Not possible. And accountancy, you see that always 2 plus 2 is never 4. Has to be other than 4. Anything other than 4. Main thing is that what is my emphasis, that this is the theory will tell you. Without theory, what we'll do, we will just make everything hodgepodge. But the theory is clear. And one shot you can understand, yes, this is that they say. Because I have to spend huge time understanding the disclosures. You do this, do that, oh, achha, they talk about actual concept, oh, yes. Now it is okay. Here is the thing, yes, the accounting mismatch. কি হয়েছে ভাই? কি হয়েছে? যাও ওদিকে রে ভাই। Now why you are a very good player of cricket, you don't understand what Dark-Wath-Lewis rule? Will you be taken in the team? 3 professors, Dark-Wath-Lewis, all Oxford University professors, they made this rule. If match is abandoned, number reduced, apply this. I don't think they have played cricket in their life. All 3 Oxford University mathematicians. So if you understand what is conceptual framework, many things will be clear at the very beginning. Otherwise, you will scratch everything. Just take one example I am giving you. One person having called his 3 sons. This person having 17 cars. Elder son, come here. X, you take half. Y, the middle son, you take 1/3. Z, youngest, you take 1/9. Half, 1/3, 1/9. 17 cars, how they divide?
You add 1 and after you will subtract after giving a view of whatever it is. You will add 1 to 17.
Why?
So that it can be divided properly.
Not possible? Because aggregate of the fraction has to be 1, yes or no?
Yes.
Is it 1? No. What he has done, 1 car given to his brother. He was having 18 cars. Half of 18 is 9. 1/3 of 18 is 6. 1/18 is 2, and 1 belongs to his brother. So if you know the theory, everything is clear. One person is in business. Okay? Went to one wizard. Well, sir, you are tremendous knowledgeable. You are not in business, but you have tremendous business acumen. So many business people come to you and take your advice. Sir, you please, I want your wisdom. I am in business and I have to take very quick decisions. I have developed my own business acumen. Without answering whether he will give his wisdom or not, he said, imagine two people coming down from a chimney. Two people coming down from a factory chimney. Who will wash his face? Because one is having dirty face, one is having very clean face. I repeat, two people coming down from a chimney, one having clean face, one having a dirty face. First question is, who will wash his face?
Clean face. Clean face.
Who will wash his face? That man says the person with dirty face will wash his face. He said the correct answer is not always the obvious one. Go back home, think a while, come back even. After 15 days he came, oh, I was so stupid. Actually the person with clean face is wash his face. Well, why? Well, he will see that his face is dirty, he will think my face is also dirty. So he will clean his face. And the person with dirty face, looking at him, but his face is clean. The mind also clean, so he will not wash his face. Well, you are a first class stupid, go back home. Answer is still incorrect. Then he came, but oh, sir, I'm sorry. It took 1 month long to understand. Both of them will wash their face. But why? Well, if one will see the other is washing his face, he will think mine will also be dirty. Then he said, is it possible that from a chimney, two people coming down, one having dirty face and one having clean face? This is conceptual framework of financial reporting.
Consistency.
You need to understand of this. Next. Expenses. First minute. Expenses, one is incurred. I have incurred. I have incurred money, and one is I have estimated. That is what? My predictive value. I made a provision, warranty provision. That is my predictive value, not confirmatory value. So expenses can be incurred. I need some asset to pay for this. And one is expenses estimated. I'm creating a provision. I don't need any asset right now. Realized will go where? PL. Unrealized? OCI. Yes. Chalo, last thing. Huh? I have started one business with 10,000 rupees. Nah, too low. 1 lakh rupees. At the end of the year, I have earned 15,000 rupees profit. One single favor, 50,000 rupees.